Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take us off course now to make it actionable, understandable, and clear. What a week, and therefore, what a show. We've got 3 items we're going to touch on. I think each of these is critical to keep our minds sharp in order to navigate the financial pitfalls that are ahead of us. We have a Wall Street Journal article by Mr. James McIntosh, headlined, "Is this wildly overvalued stock market doomed?" Yes, but maybe not yet. It's an excellent summation of some of the themes we've discussed in previous episodes. We're also going to dig into a little Robert's Corner extended. That's right, that segment that the fans can't stop talking about. Robert's Corner, where I look at my personal interactions and my personal dealings in the financial world, and I share those with you. It's a wonderful day in the corner. Won't you be my listener? We look at dividend announcements. Ding, ding, ding. That's right. Vanguard came out with their final estimated year-end distributions. You didn't know how exciting this was. I'm going to hopefully make it exciting for you. It should be to the long-term investor. And then I discuss tales from the 401k audit. So in my line of work, I am often tasked with evaluating an employer's 401k plan to ensure the client is in the best possible funds. We visit one of those instances, and I know some of the information could probably be helpful to you as you think about your own employer plans and what you should do. But let's circle back to the top. Mr. James McIntosh, "Is this wildly overvalued stock market doomed? Yes, but maybe not yet." Subheadline, "History shows no link between nosebleed valuations like today's and next year's returns. Expensive stocks can always get pricier." So I also want to examine some presuppositions he makes. So when he says, "Is this wildly overvalued stock market doomed?" I'd ask, by what standard? So he says wildly overvalued. By what standard? And ultimately, maybe price to book, price to earnings, historic, all the rest. Because these sorts of headlines can whip us into a frenzy as a reader and convince us something's expensive. Maybe it isn't. Maybe it's not. I do like what Mr. McIntosh is saying about no link between these nosebleed valuations. So we think they're nosebleed and next year. So be careful as you digest financial news. There's been a lot I've read that has presupposed, this market is incredibly expensive, incredibly frothy. Yet I've kind of heard that for so many years now but check this out. Here's what he says. Goldman Sachs, ever heard of him, thinks the S&P 500 will make just 3% a year over the next 10 years. Okay. Goldman Sachs' theory is that big tech dominance eventually falters. So a lot of smart Aggies over there, so we got to give them a little credit. But they say Bank of America expects 0 to 1% returns a year for a decade. And then I've mentioned Vanguard before. They came in at like 4 point something, 4 or 2. So when we hear things like that, it can take us off course, as the intro explains. I like what McIntosh says here, that expensive stocks can always get more expensive. And the history lesson I like to provide is 1996 to 1999. In 96, and it might have been Buffett who came out, it might have been 97, at one of his symposiums, or he was at some speaker series, and he just explained in very clear, plain language, it was 97, 96, how overvalued the market was by his metrics and standards, and how it would crash. Now, of course, we would have loved to have just picked it right, sold in 99, bought in 01, call it a day, sold in 1929, bought in 1932. We can't do that. And it's really a dangerous, dangerous game to pull off. So what are we to do? It's to not overthink this thing. So Mr. McIntosh goes into the nitty-gritty on, he says, artificial intelligence, if it works out. He actually thinks earnings might catch up, because that's the E and PE, price to earnings. Earnings is what a company is actually making. And so McIntosh says, well, In 2000, the tech bubble, the internet companies were not making money, whereas today they are. Therefore, this is different. That's count a check mark by, hey, maybe this market's not crazy. And then American exceptionalism. Now, most of my listeners are American, so you delight to hear in this American exceptionalism for those in Spain. Por supuesto, lo siento. It has been the case that American stocks have just been on a tear. McIntosh explains, and he gives data I didn't know. So he says the gap is really, really big. U.S. stocks trade for 22.5 times forecast earnings. The rest of the world is at 14 times earnings. He's saying the U.S. market is at its highest valuation relative to the rest of the world on forward earnings since at least 1988 when data collection began. All right. I've heard this a jillion times. And you know how valuable it's been to actually rotate in international stocks for the last 5 years? Not at all. Not at all. The valuation gap has only increased over time. A lot of this data, and I'm going to give international its due in a moment, but a lot of this data is pretty recent. Since 1988, we really don't know what's normal. This isn't like gravity or water, H2O, where we kind of know the rules of the game. This is valuations of stocks around the world. We have no idea what the future relationship will be between U.S. stocks and international stocks. Wish I did. We'd have a much more popular podcast where I'd get on and say, all right, listener, hit the buy button this week and go ahead and sell those international stocks because that's what's going to be the best shot on your investing journey. No, we give a different sermon here, don't we? More of a Jonathan Edwards type sermon where we say, keep those costs low, investing simple, time horizon long. We give them that old time religion, not the new age, feel good, prosperity gospel. We tell them the truth. So just because this gap is wider than it's ever been, oftentimes as a listener, you think, I must rotate out. I remember showing some of this data to a client and in their earnest zeal, they said, great, I'm 100% international. Whoa, wait. So here, don't go too far. My theory is you need an allocation to international so that if we entered a decade like the 1970s where just about every year international outperformed, you don't bail. My philosophy is not that you need to rotate in and out of international and U.S. based on valuation and historic valuation. My philosophy is permanence. It's permanence that is going to dictate the best returns on financial plans, and therefore we need to find plans that people will stick with. It is my conviction you and I will stick with plans that have allocations to both U.S. and domestic, and when one does well, you're cool, and when the other does well, you're cool. So the end of the article with Mr. McIntosh says this, but if you think the market is wildly overvalued and the long-run outlook is awful, you could stop worrying and buy 10-year treasuries at 4.2%. 10-year treasury bills, that's the United States government, your government, most of you. And I fear that for many investors, they will simply punt. Don't do it. Don't do it. Don't worry about it. Hang in there. Keep your time horizon long. And then that's a great transition. Oftentimes I will tell investors, don't get excited about the stock market going up. Do not get excited about it at all. Don't even think about it. And then as a listener, you might say, well, Robert, what can I get excited about? My college football team did not make the playoff. I don't have a lot to be excited about. I'm talking to you, Aggies. What should I do? And Crimson Tide. Well, there is something to get excited about. You know what's exciting about investing? It's just like you should be as excited about investing as you are about farming. When the crop comes in, be excited. Be delighted. Do not be excited when your neighbor across the street yells price quotes to buy your entire farm every day, which is what the stock market is. Every day, you're getting price quotes on the entirety of your 401k, your brokerage account. Mr. Market, that's the collection of every buyer and seller who's in their tree seeking to find this price equilibrium. He's yelling prices every day, all day. We'll just pretend like that was a family farm. If the neighbor across the street was yelling prices at you, would you care? Not really. You just say, oh, whatever, I'm not a seller, whatever. What do we get excited about? When the corn crop comes in, when the soybean crop comes in, when the crops come in. What are the crops? How far can I take this analogy? Gather the children in for this one, or the horticultural majors in for this one as well. Dividends. So Vanguard just came out with a couple days ago. Final estimated year-end distributions. I'll put this on the show notes. Every Vanguard fund is providing their estimated distribution for their fourth quarter dividend. And I scooch down to the exchange traded funds section, which is page 9 if you ever get into it, and you see these ticker symbols, VOO being the S&P 500, VEA being the developed market. And something I'll do is I'll just look up what the trend is on the dividends. And I saw that, VOO, this S&P 500 index, it's going to do about what it did last year at this time. So Q4 to Q4, December distribution, the payable date is December 26th, 2024. It's about the same. All right, so you're kind of flat. International came in higher, and it's a little more volatile because you're dealing with currency exchange rates. But I'd encourage you to come over and hang out on this side of the excitement aisle for investing, because if you can get yourself out of the price action volatility game and into the soybean corn harvesting game, i.e. dividends, and track those, it's a lot smoother ride. To give you just a little nugget to think about, if you look back in financial history and you look at, say, 1929 and 1932 and how the dividends held up, if you look at most recently COVID, how the dividends held up in America, they really didn't get hit that hard. Stock market, huge ride, but dividends are a smoother ride. So it can be to our advantage, investor, to actually follow the dividends. And I know for many of us, most of us, especially if this is in 401k, it's on auto reinvest. I'm not even thinking about it. You're not thinking about it, but you should. I think it can be a helpful heuristic to evaluate the manner in which your investments are doing. And guess what? Not as volatile, and it's more steady eddy. A little nugget for you here that you just probably only get on this podcast is there is a difference between the way American companies pay dividends and European companies. American companies typically pay what's called a fixed dividend, meaning that Coca-Cola or Microsoft or whoever else will say, hey, we'll pay you a quarter, 25 cents every 3 months, and that'll be your fixed dividends, and they will just pay it whether earnings are good or bad. In Europe, they will do a percentage of earnings, and that percentage of earnings means it's pretty volatile. That dividend will kind of go up and down, particularly if your company had a good year, dividends are up. If it didn't, dividends are down. So a little different. That's a more conservative way to manage your balance sheet over in Europe, whereas in the U.S. with that fixed dividend, those companies can really try to stick with it, and then they kind of burn out. So AT&T is a recent example. They were one of these high dividend payers in America. Steady Eddie, you can count on us. And they just borrowed money to pay the dividend and borrowed money. And then eventually they couldn't sustain it. They cut the dividend in half and had a big, it's kind of these big restructures. And AT&T is doing fine now, but their dividend yield got really high because people didn't think it was sustainable. So be willing to get excited about the long term. This is an exercise I use that helps me. And then we transition to tails from the 401k. So every 401k is different. If you've met one 401k plan, you've met one 401k plan. Of course, there are going to be similarities. And of course, if I work with someone who's at the same employer, it's very easy for me to bounce around and remember what they did. But I'm helping someone out, and I take a look at, I'll leave the company nameless just because my legal department doesn't want me to take any heat, but there's a new company, great new 401k plan. I'm looking at the options. The options include, great, there's a Vanguard Total Stock Market Index return option. Oh, delightful. But you know what? I say, I'm going to look this thing up because this particular company is notorious for hosing its customers on fees. So, let me look it up. I look it up. You're going to want to gather the children in for this one. The Vanguard Total Stock Market's return option. Guess what the expense ratio is on this thing? I want you to guess. Do you have it? It is 0.79% for this index fund, this Vanguard US index fund total. Do you know what it is off the street? 0.03%. So just, listener, think about this. If you just went with the name, and I almost, I'm pretty savvy about this stuff. I saw the name. I see Vanguard Total Stock Market Index. Fantastic. What a delight. This is 26 times as expensive as the Vanguard Total Stock Market Index that you buy just on your brokerage account. This is how sharp we have to be, wise as servants and innocent as doves when we are navigating buying financial products. The kind of phrase I like to use is, do you know how much your shoes cost? Well, sure. Do you know how much milk costs at the grocery store? Well, sure. Do you know what it costs to buy financial products in your plan? I get the glassy eyes. I know the answer. No, I have no idea what it costs. That's because they make it real opaque. If I were a regulator, if Donald Trump asked me to be his czar of the Consumer Financial Protection Bureau, which he may eliminate, Doge may eliminate, but if they made it a committee of one and I got to do it, I'd be so excited. So, Mr. Ramaswamy, Mr. Musk, think about me for that role. I'd work remote. I would have only a couple things. One rule. I would say, you have to put the expense ratio as a part of the name of the fund. Aha! The lobbyist would go bananas on that one. But I'd make it a name of that. You can keep the ticker the same. Just anytime you say, hey, this is the, this is the State Street or BlackRock or American Funds or Victory or PIMCO, whatever, just put the expense ratio out to the side. And I know not everyone's going to know what the expense ratio is, but boy, isn't that transparent. That's one of my rules. My second rule, if I were this czar in this Consumer Financial Protection Bureau in my mind, if Mr. Ramaswamy asked me, I'd say, you must tell your client what it costs for you to be their advisor each year. And you must, and that's on the advice side, and on the product side must tell you at the end of the year what they charged you to own their funds on a nominal dollar basis, not on a percentage. I think those two changes would clear out so much graft and gobbledygook and Merck and Meyer, and we have so many rules at the state level, at the national level to protect consumers. The best way to protect consumers is to equip consumers, you and I, with information. Like, what does this cost? Because some of the sharpest folks I know walk into my office and have no idea what it costs for their investments. And so and that's not on them, by the way. Like, these are diligent, intelligent people. That is on the industry who has chosen to remain opaque. Why have they chosen that? As King Solomon once said, bread is good for laughter, and wine makes life merry, and money is the answer to everything. So the almighty dollar is what's motivating this opaque cost structure. So that's okay. That's the way the world is. We live in the world as it is, not as we wish it would be. So be willing to ask for that price. Be willing to dig. Hire an hourly financial advisor because you know what they cost. Pretty simple when it hits your credit card bill. There's no real question. Let them dig into this, tell you what it costs you. It's going to really fast track your investments and make a huge difference over the long haul for those investors that have the right mindset, which is to keep those costs low, keep that investing simple, and keep your time horizon long, because that's what's going to give you a shot on your investing journey. Until next week.